Hey there, everyone. This is Tom Vilord from Wall Street Value. Sorry I haven't given you a tip in a while. I took some time off for the Christmas break, but we're back at it now. So here is the checklist tip number 9, the PEG ratio. And if you haven't read One Up on Wall Street yet, do yourself a favor and get a copy. This is written by Peter Lynch, and he was a fund manager for Fidelity. And throughout the 90s, the 80s, he was known for being the rock star fund manager for the Magellan Fund. And during his time there from 77 to 1990, he posted an astounding annual rate of return of 29.2%. So in this book, One Up on Wall Street, there's a lot of great ideas, but the one that I use the most is the PEG ratio. PEG ratio is the price of the stock divided by the earnings, which is the PE ratio. When I do this, I either use the trailing 12-month earnings, or if Value Line has a good earnings predictability score, then I'll also use the future estimated earnings as well. So this is going to give you the PE ratio. So what we do is we divide that by the annual earnings per share growth rate. So price to earnings divided by the earnings per share growth rate gives us the PEG ratio. And this ratio is good for a couple reasons. So first, since growth companies tend to have a higher PE ratio, some see a higher PE as being overvalued, which may not always be true. So the PEG ratio is good for comparing companies with different growth rates, especially growth stocks. So another advantage of the PEG ratio over the PE ratio is that this accounts for future growth, which the PE ratio by itself does not account for. Lastly, and the reason I use it is to see if the company that I'm looking at may be undervalued. So the PE ratio of any company that is fairly priced will be equal to its growth rate, and that'll give a PEG ratio close to 1.0. But if we have a company that has an earnings growth rate that is higher than the PE, that could potentially be undervalued. So we want the earnings growing at a higher rate than the current PE. So if it's 1.0, it's a fairly valued company. If the PEG ratio is less than 1.0, that's really good. That means that this company is potentially undervalued. And then if the PEG ratio is greater than 1.0, that means that PE is higher than the growth rate. That's not what we want. And that could represent a company that may be overvalued. As we've already mentioned, you can use the trailing earnings or projected earnings for the PE ratio, and only use projected earnings if Value Line gives them a favorable predictability score. And I usually set my limit at 85. So as for the earnings growth rate, you can use the historical earnings growth rate. You can also use the expected 1-year growth rate or the 5-year growth rate, or you can add them all together and take the average if you'd like to. Earnings growth rates can be found in the analyst section on Yahoo Finance and on the fact page on Value Line. And you can also find that in the 15-year financial section on Guru Focus. So I was looking at an article on Dollar General, and the author seemed to like the prospects for the short term. Now, as I'm recording this is January 2018. I actually did this analysis several months ago in 2017. So at the time, the current PE was 15.14. So the current price was $71.93, and I was using the 2017 estimated earnings, which is $4.75. Their growth rate historically has been 11%, and that's according to Yahoo Finance, 6.6%, which is their 1-year estimate, and just a hair under 10% for the 5-year estimate. So here's how the numbers look using each of those growth rates. All 3 examples, I got a PEG ratio well over 1.0. So I don't like how any of these look. We want the PEG ratio to be under 1.0. Now, here's another example when you take a look at 2 different companies with different PEs. This is a way to determine which may be a better value. So first, we're going to look at Company A, and they have a current price of $46 a share. The current earnings per share is $2.09. Their previous year EPS, or earnings per share, was $1.74. So 209 divided by 174 gives it a growth rate since last year of 20%. Their current PE, which is the price of the stock divided by the earnings, has a PE of 22. So 22 divided by the earnings growth rate of 20 gives us a PEG ratio of 1.1. Now if we look at Company B, they have a stock price of $80 a share. The current earnings are $2.67. The previous year's earnings was $1.78, so the year-over-year growth is 50%. The current PE is 30. So looking at that 30, some people might say that's a pretty high price to earnings for a company, and therefore it's probably overvalued. But the PEG ratio shows us that if it's at a 30, but growth is growing at a faster pace than what the PE is, it could still potentially be an undervalued company. So here we have a PEG ratio that's well under 1.0. So investors are going to look at company A and find that more attractive because it has a lower PE compared with the two companies. But when you look at company B, company A does not have high enough growth rate to justify that price to earnings. So company B is actually trading at a discount to its growth rate, and investors purchasing it are paying less per unit of earnings growth than they are if they bought company A. So company B, based on the PEG ratio, is a better bargain. As with everything that we've taught you in the course so far, in the videos, if you're just watching our videos on YouTube, there's no one singular metric that is the king of all metrics. This is not the be-all, end-all determinant of whether or not a company is good or bad, or if the valuation is fairly valued, undervalued, or overvalued. It's just one more tool that we have to use, and we haven't even gotten into the 13 valuation metrics yet. So it's just one easy thing to look at to be able to tell if a company may be undervalued. But we still have to do the rest of the work and do the calculations to figure out where the stock price should be. So it's another tool in the toolbox you should look at along with everything else we're teaching you. We want to put as many odds in our favor as possible, and this is one more thing to look at while doing our research. So that's it for this video. I appreciate you tuning in. Don't forget, you have one more day to register for the 16-week stock investing and options trading class. That's going to start tomorrow, January 9th, and it's going to be from 6:30 to 7:30 p.m. Eastern Time. And we're also going to have office hours for a live Q&A every Thursday at 12 o'clock p.m. And these are both going to run for 16 weeks. So if you have any question or any interest, give me a call or shoot me an email at tom@wallstreetvalue.com. Thank you.